The most expensive financial mistake isn't buying something you can't afford. It's believing you're saving money when you're quietly destroying your future wealth. That sounds impossible until you notice how often people celebrate spending less today without asking what that decision will cost tomorrow. Your brain loves immediate victories because they feel measurable. $10 saved, $50 discounted, $100 avoided, but it rarely calculates the invisible losses that accumulate in the background, and those losses are often far larger than the money you think you're protecting. Imagine someone driving across town to save the equivalent of a few dollars on groceries. They spend extra fuel, an hour of their time, and arrive home mentally exhausted. Financially, it feels like a win because the receipt shows a lower number. Yet if that same hour could have been spent learning a valuable skill, improving their health, or simply avoiding stress that hurts tomorrow's productivity, the real balance sheet tells a different story. Humans naturally focus on visible costs while ignoring invisible ones. Economists call this opportunity cost, but in everyday life it behaves more like a blind spot than a calculation. This is why cheap can become expensive. Consider buying a low-quality pair of shoes because the price seems irresistible. 6 months later, they're worn out, uncomfortable, and need replacing. Someone else bought a more durable pair once and wears them for years. The first person believed they were saving money. The second person actually did. This pattern repeats everywhere. Tools that break, appliances that fail early, furniture that needs replacing, software that wastes hours because it lacks useful features. Price is paid once. Cost keeps arriving long after the purchase is forgotten. But the biggest financial leak isn't found in shopping carts. It's found in time. Imagine declining a course because it costs too much, then spending the next 5 years earning less because the new skill was never acquired. Or refusing to invest in better equipment for work because the upfront expense feels uncomfortable, only to lose hundreds of hours through inefficiency. Our brains are remarkably sensitive to immediate spending, but strangely indifferent to slow, invisible losses. A single payment triggers discomfort. Years of missed opportunity barely register because they arrive one unnoticed day at a time. There's another trap hiding beneath this behavior. Saving money produces an emotional reward even when it creates a financial penalty. Retailers understand this perfectly. A product marked 40% off activates excitement because the discount feels like a gain, even if the discounted item was never needed in the first place. You don't compare today's purchase with buying nothing. You compare it with the imaginary higher price that existed only moments earlier. Suddenly spending becomes mentally classified as saving. It's one of the oldest psychological tricks in commerce, and it works because our brains evaluate changes more easily than absolute value. Now extend that thinking beyond shopping. Imagine refusing to invest a modest amount each month because you'd rather keep the cash available. At first, nothing dramatic happens. Your bank balance feels reassuring. But while your money sits still, inflation quietly reduces what it can buy, and investments that could have grown over years never get the chance. The danger isn't one missed month. It's the compounding effect of hundreds of missed months. Compound growth works like planting a tree. Waiting another year doesn't just delay the harvest. It permanently changes how large the tree could have become. History offers countless examples of this hidden mathematics. Some of the world's most successful long-term investors have repeated the same lesson in different words. Time is usually more valuable than perfect timing. Waiting for the ideal moment often feels responsible, but hesitation has a cost that never appears on a receipt. Markets recover, skills compound, relationships create opportunities, and experience builds confidence. None of these rewards arrive instantly, which is exactly why our brains undervalue them. This doesn't mean every expensive purchase is wise or every bargain is a mistake. The real question is different. Instead of asking, "How much does this cost today?" ask, "What does this decision cost over the next 5 years?" Suddenly, the cheapest laptop may become the most expensive because it slows your work every day. The higher quality mattress becomes an investment in better sleep energy, and productivity. The educational course becomes a tool for future income rather than today's expense. Your perspective shifts from transactions to trajectories. The strange truth is that wealth isn't built only by spending less, it's built by avoiding expensive forms of false economy. The world trains us to celebrate visible savings because they're easy to count, but financial progress often depends on protecting things that can't be seen on a receipt: your time, your health, your skills, your attention, and your future earning potential. Those assets quietly determine every paycheck you'll ever receive. The next time something feels like a smart financial decision simply because it lowers today's expense, pause for a moment. Ask yourself what version of your future is being purchased along with that choice. Because the most dangerous money trap isn't spending too much. It's believing you've saved money while paying with the one resource you can never earn back: the years your future wealth needed to grow.